G-Ball and Amber Data podcast. I'm here with Joe from Opyn. Opyn is a DeFi options protocol. Joe is going to explain to us some of the mechanics behind Squeeth and an overview of Opyn. Joe, how are you?
I'm really good. Thanks for having me on.
Absolutely. I'm happy to finally virtually meet. So it'll be great to kind of maybe learn a little bit about your background and how you found your way into crypto and how you found your way co-developing Squeeth, which is a very interesting product in the DeFi space. So maybe if we just start with your background, what's your what did you study and where did you work before coming into crypto?
Many years ago, I did a PhD in economics, and which was in game theory and industrial organization, and I fell very accidentally into finance by a team walked out at a proprietary trading desk, and the head of the team called my university and asked if anybody knew how to use MATLAB, which is what they had coded all their models in. So I got brought in on a consulting project to figure out what was going on with this big code base, massive code base of different trading models for trading futures and options. And I really liked the project, and so I abandoned. I thought I would temporarily abandon academia and go for just a couple of years out to try what it was like trading on a desk, and I never made it back yet. So yeah, I was kind of like accidentally fell into a global macro hedge fund essentially, and there the main trades were but just across currencies, bonds, and equities, macro positioning between countries, carry trades, and various kinds of momentum and mean reversion strategies. It was kind of like a big mixture, which was a great way to get introduced to trading, and being thrown into trading live, having to trade live on semi and CBOT with very little instruction, which was great because it's the only real way to learn.
Wow, that's fantastic. So it's the team that the hedge fund had hired, that team left, and so the hedge fund was just stuck with this MATLAB code base on its hands with no one there to interpret it. So they basically went and plucked you out of academia to basically solve that issue for them.
Yeah, it was crazy. They could run it, but they didn't know what it meant.
Wow, that's amazing. So did you stay with that hedge fund until you went into crypto, or was there somewhere you went after, and how did that transition work?
I was there for 4 years, and I became a specialist. After a couple of years, I specialized in options trading because it was very interesting. It's kind of like there's a lot of structure in the options problems. And so I started trading soybeans and crude oil and gold, as well as some equity options. And then I went to join a team, like my team. Many people in my team moved to another Australian fund, and I moved with them. And there we did similar kind of stuff for about the next 10 years. We built kind of quasi hedge fund processes, where you have long and short sides of things across lots of different asset classes, and tried to kind of find common processes that worked, and were kind of within the risk parameters of funds, but also we thought were economically sensible. And a lot of that ended up being in options.
Wow. So that's fascinating. So you guys are using all this heavy tech, but it's not necessarily to be like market makers. It's still sort of discretionary, but it's based around correlations, relative vol, things like that.
Yeah, exactly. The focus was specifically on the volatility side to find markets with to buy vol and cheap vol markets and sell vol and expensive vol markets, and be able to kind of like figure out how we think that, say, the crude oil volatility surface will behave relative to a currency volatility surface or an equity volatility surface, which is like a question which you never get to the bottom of. So you can happily spend 10 years digging around these surfaces and trying to find and finding value, without ever really getting to the bottom of everything.
Yeah, that's really fascinating. So, is there sort of a fundamental thesis, like a catalyst, like let's say I'm trading Brent versus WTI, and I fundamentally think those are going to change because of geopolitics? Or is it mostly you guys are comparing time series analysis and saying like, oh, this time series analysis looks different than it looks like on average, and therefore I should do something here?
Like a combination of the two.
Mm.
Like to some extent, like we have great data and we have very high frequency data, and so we can look for statistical connections between the surfaces. But much more, I think, at a high level, it's far more interesting and usually more profitable to figure out that there should be some structural connection. If natural gas is going to be high, then something about what's going on in the electricity forward markets, for example. There's structural stuff that you can get. We know, for example, that credit, like corporate credit, is like a big put option on large companies, and so we know that equity vol will trade in a crisis. Will trade with credit. And so those that's really the goal, to try to find little nuggets like that, and then you can build an interesting trade.
That's really fascinating. So you have this background in traditional assets. I mean, it sounds like it's a pretty sophisticated system that you guys were working with or working on and building. So how did you find your way into crypto, and what's sort of piqued your interest into the crypto world?
I think a very similar story to a lot of people. I think I had started reading up from probably around 2011. Started reading, or maybe a little bit before, but in earnest started reading in about 2011. And I thought to myself, this is great. Like, we're going to be able to to solve a lot of the problems that we have in traditional finance. We can properly make decentralized exchanges. We can do margining properly. We can cut out the brokers. All of the things from a traditional finance perspective, there was like a bunch of things that had annoyed me, and every one of those things you can't do really anything about from most places within traditional finance. And so it only took me 11 years from that point to finally go. And the catalyst was actually my wife. My wife got started at Caltech, and so we had to move from Melbourne to California. And so it was a great opportunity to say, well, I should just go and do this crypto stuff, which I've been doing on the weekends. And I was writing papers and starting slowly getting more and more involved. But I was able to, through virtue of her forcing me.
Wow, that's really fascinating. So you actually have like two very interesting perspectives into this space. One is you're sort of building one of the most sophisticated and like cutting edge products, which is Squeeth, in DeFi options. But on the flip side, you also have this background in trading and trading vol. And so on the trading vol perspective, something that to me seems really compelling for crypto is that crypto hasn't been figured out yet. Like, no one can really say what crypto should be worth on a spot basis. And then even less so, in my opinion, like what are the true tail risks and catalysts in the vol space. Do you think there's any corners of crypto vol that you find personally fascinating that, oh, like maybe these correlations, or like, ERC20 versus ETH base, stuff like that?
One thing, like every part of it is fascinating. One thing which I think hasn't been done at all, which will be very interesting, is correlation structures. So in currency, you'll have like Aussie US and US yen will trade, but then Aussie yen as well. And the market has to imply a correlation as soon as it starts pricing enough cross assets. Hasn't happened yet in crypto. I'm very excited when it does, because then the people's guesses now about how these markets are connected will become more formalized, and you'll be able to say, I happen to believe that like Solana and Cardano are going to have this relationship together, and you can be very explicit about structuring a portfolio that is that has a payoff that depends on that correlation very explicitly. So for me, that's like the frontier, which crypto, the one thing which hasn't really been started yet, which I'm really excited to see.
Yeah, that's an interesting corner. I have a friend who's very like pays attention to the Bitcoin ETH ratio and wants to trade options on sort of that ratio specifically. And so kind of like what you're saying, it's like ETH dollar, Bitcoin dollar, and then sort of the top of the triangle is the ratio, and what does that vol surface look like? That's an interesting sort of problem. So maybe for people who don't know Opyn or don't know Squeeth, could you just briefly talk about what Opyn is and what you guys are working on over there?
Yeah, sure. So Opyn is a options infrastructure provider. We write contracts, like Ethereum contracts, for people who want to have European options. Or this was the genesis in 2011, was using it was a way for people who want to trade standard European options and settle on chain. They have a contract that can do that. That deals with the margining for the short side, allows spreads, and has some plumbing for people who want to make their own options. From there, and I think it was largely driven by one of our large customers was Ribbon, or they weren't Ribbon at the time. They started using Opyn options and turning them into these vaults where they would systematically sell options to market makers. They would find market makers and they would sell options and create an on-chain strategy of option selling. And so we kind of followed, and this I think slightly before I joined, Opyn followed in this direction and started expanding to strategies, allowing people to build their own strategies where they can specify that they want to have all sorts of options and all sorts of futures and different kinds of rebalancing, and that they would be able to unitize that, so people can somebody can create it, and then everybody can just buy an ERC20, which represents that. From there, this I think was kind of like it solved a bit of the problem. So you have options, great, basic options. Then the vaults of options, which kind of like abstracts away from the difficulty of like running an option strategy. But it still doesn't abstract completely, where you still have to deal with option strikes and option expiries. And so the idea that I think like Opyn had when I joined, and when I was really excited, I think the real reason why I joined was they were asking the question, how do we get rid of strikes and expiries from options? How do we turn them into a perp? Because perps clearly had great product market fit in crypto, and it hadn't been done. There are some things which are similar in certain swaps, but the idea of turning an option into a perp and having it trade very generically was like a key to this liquidity problem, as from what I saw. And it kind of like generalized vaults. So it made a nice progression for what Opyn was doing. So we have obviously an option protocol and vaults which are used by a lot of people, like Staked Hours creates a lot of option based vaults. Yearn as well. Ribbon at the moment, I think they're going to go on to an L2, which is very exciting. And so our part of our focus is still looking back onto the traditional options market, and part of it is saying, we want to continue to perpify options, to make them very simple, and to make it very easy for you to you can just buy this thing, which gives you an option-like exposure, which has Greeks, has like gamma, delta and gamma and vega, what people are used to, but it doesn't expire and you don't have to worry about the strike.
Yeah, Go ahead.
Go ahead.
I was gonna say
There you go.
I was gonna say that's an interesting insight about perps. So people who are sort of new to crypto, the perps market is kind of like a future that never expires, and instead there's a daily cash flow to pay for funding. And so there's a lot of liquidity that got all aggregated into perps because now it's not fragmented across expiries. And so your guys' vision was similar to that options has fragmented liquidity. If I can just isolate the convexity of options and put it in one instrument, theoretically the liquidity would be better because it's all aggregated in the same place. That's pretty interesting. So sorry, go ahead, say what you were gonna say.
Yeah, exactly. And it's like this, the dream of having like a single place where option market risk can trade. Partly so that to improve the liquidity on the option markets, because if enough trades in this like single asset, then it means that it's easier for people to trade, to price risk and to market make in traditional options.
Yeah, interesting. Now, something that's different about Squeeth versus the perps market. In the perps market, there is sort of a funding cost, transfer of funds to pay for funding. You guys did it a little bit differently where it's more implicit. Can you touch on sort of the funding aspect of Squeeth?
Yeah, so there, in normal purposes, you have the same thing where you need to transfer some amount of funding between the long and the short side of the trade, and that serves to equilibrate the market. If the market moves too far in one direction, then this funding cost will be, whoever's on the other side of it, people will be paid to make the gap smaller via this funding. If it goes in the other direction, it switches around. And so it's a necessary part of getting equilibration in it for any perp. But if you do this for an ERC20, like it's a standard token, then you start sending actual cash payments. Then it breaks the API of a standard token.
Mm-hmm.
It can be done, but it makes it very difficult for that token to interact in a normal way with the rest of the ecosystem. It makes it difficult to use it as loan collateral. It just makes it like an outcast token that has like, and so we constructed the system so that you don't pay explicit funding, but when you mint, the amount of your debt gets reduced a little bit. The value of your debt gets reduced a little bit instead of funding, and that gives you the same effect as funding, but there's no actual payments that need to be made. It's just you're saying whoever mints and therefore has a debt of Squeeth has a slightly lower, if its funding is positive, has a slightly lower debt every day, which is the same as transferring money from the long side to the short side. So yeah. It's an abstraction to try to make it so that we can have a very easy to use standard ERC20.
That makes a lot of sense, and it's almost as if like the long opts into funding in the sense that if they don't want their position size to shrink, they themselves will add to their position to keep it constant, which is essentially a funding payment that they do.
Yeah.
So
exactly.
So we actually cover some Squeeth metrics at GVol, implied vol, the Greeks, things like that. So maybe you could just touch on that as well. Like, how does something like a power-perpetual such as Squeeth have an implied volatility that's comparable to vanilla options that we find on Derivs?
Yeah. So if I can take a bunch of options and I can construct the Squeeth payoff. I can recreate the Squeeth payoff. And Squeeth Vol is kind of asking what it's some like kind of approximately what's kind of the average implied volatility of all these options, which allows me to get this Squeeth payoff. So I pay a certain amount for Squeeth, and I can convert just like an option has an implied volatility, which we convert from the price. Squeeth has an implied volatility, which we get from looking at the underlying option portfolio, which generates it.
That's interesting.
So it's actually a bit, so structurally, you'll have, we have at the money volatility, or we have like a volatility for a current option. We have the like the DVOL, the VIX like variant swap that you guys do, which you do amazing work there. And a variance swap is what's going on in a variance swap is you have a log contract, and you have like a contract which gives you the log of the payoff of an asset, and it has, in order to get that log of the payoff of an asset, you need to have lots of put options and just a few call options. And so it will be very sensitive to skew. If the puts become very expensive, then something like DVOL will spike up very high. But Squeeth, the portfolio of options is just a constant amount of options at each strike, and so it'll be flatter compared to the option surface. So I'll have it's a bit like a very simple average across all the implied volatilities of an option will get you about what the Squeeth implied volatility is.
That's an interesting insight that I never thought about. So let me just maybe restate that just to make sure my understanding is right. So in something like VIX, I'm trying to target sort of constant vega. So therefore, as the price goes down, I have to have more put options to sort of keep it constant. And so it creates more weighting on the put side than the call side. Now, you're saying Squeeth doesn't have sort of that difference in weighting, and it's more constant across the board. Wow, interesting.
Yeah, so I just have a constant. If you take any asset and just have a constant amount, about like one option every $10 worth of strike, you'll get Squeeth. You'll get a squared contract.
Now, does that mean that we could theoretically see divergence in, say, DVOL and Squeeth because of shifts and skews and stuff like that?
Yeah. We'll tend to see like DVOL will tend to be a fair bit higher. It'll be like 5 to 10 vols higher than Squeeth vol, and they're both saying the same thing. They're not like at odds with each other. One's just the replicating portfolio for a variance swap happens to have lots of puts in it, and the replicating portfolio for Squeeth happens to have a constant amount of options across all strikes.
That's insightful. So on something like Squeeth, where the funding costs are implicit and sort of the normalization factor keeps shrinking and shrinking, what happens when it starts to get towards zero? Is that something you guys mainly like launch a new Squeeth token that restarts at 1, or how does that work? Or can it just keep going down for infinity?
It can go down. There is a limit because we only have 18 decimal places to deal with, but it can decrease. Like it's like a exponential decay function. So it gets smaller, but it doesn't go like it's not a straight line down. It'll get smaller at a slower rate. And so we looked at it, and it would be about 70 or 80 years at current vols before we would have to rebase the contract. So we feel like we want to plan for the 70 or 80 years, but we don't feel that we have to do the rebase yet. We don't have to worry about the rebase yet. Simply because it doesn't matter. Like if it goes down, it can be very, very low, but we have 18 decimal places to play with, so it kind of doesn't matter.
Yeah, okay. So the limitation is an Ethereum-based sort of decimal place limitation. That's cool. So what kind of adoption are you guys seeing? Like when I look at Squeeth volumes, they're actually pretty healthy. Do you know some of the people who are are institutions starting to trade Squeeth, or is it mostly DeFi natives who are, trading DeFi options via Squeeth?
We have a combination. I think there's a lot of we initially had like a lot of retail people who wanted to have a leveraged position which doesn't get liquidated. So they wanted to have a position like a perp, but they didn't want to get liquidated on the downside. Squeeth does that. But increasingly we have market makers who realize that they can trade Squeeth against options that they buy on Derivs. And it's almost a perfect arb for them to trade those options against Squeeth. So they'll come in and be price makers against their options books. So we'll see a fair bit of that. We'll see a lot of people, particularly at low vols. Recently, like vols been low, as you know, across all the surfaces, and it's possible to hedge impermanent loss on Uniswap or on Curve or any AMMs with Squeeth. And so we see a lot of people either doing it for themselves. They'll buy LPs, or they'll hold like leveraged Uni V3 LPs or whatever equivalent they have on any other chains, and they'll hedge the gamma of that with Squeeth, which is just a pure gamma product. So impermanent loss. From an options perspective, it's of course very funny seeing like people learning about AMMs and being confused about the convexity of the AMM and making up a whole new word for it, a whole new phrase, impermanent loss, when really we know that it's gamma P&L. And so it's very normal for us to say, well, you have a nonlinear payoff, and so you're going to have some gamma and some gamma P&L. So it's very exciting to see that. We kind of promote that a bit and try to help people out to figure out how they can size their uni LPs against Squeeth and what the risks are. And being able to get sized for the trades with market makers or through auctions.
That makes sense. And
yeah,
then,
that's the spread.
And then something like VIX or DVOL targets a 30-day constant maturity. When I'm talking about Squeeth maturity, my understanding is 17 and a half days, but am I misunderstanding that?
It's an average of 17 days, so it's like a weighted average. It's like an exponential decay from an option expiring immediately to an option at infinity with a weighted average of 17 and a half days. So that's the way we think about it. So we actually have to create to arbitrage it perfectly. You would need options for every one of those expiries. But we can obviously just pick a few to get a pretty good hedge.
Yeah.
So exactly right in thinking it's 17 and a half days average, but with more of a weight with a higher weights on lower expiries.
And that's slightly different than the VIX calculation, because my understanding of the VIX calculation is just a weighting of sort of the closest and farthest expirations, two expirations that are one above 30 and one below 30, and yours is across the board theoretically for the average of 17 and a half. Cool. So it's more robust from a term structure perspective.
It is. I mean, we don't kind of advertise it from that perspective, but it is it's better. It's a bit safer to get the price, because we're going across a whole surface and it's not just picking up on a single point. But yeah, we can create a quadratic expiry at 17 and a half days, and we know what price that is, but that's not the exact correct portfolio that represents Squeeth. So yeah, we it's like at each expiry there's a constant amount of the options, but there's a decreasing weight across the term structure.
And when we look at the mechanics of Squeeth, so going long is rather simple. I basically can go to Uniswap and buy Squeeth tokens, and now I'm long Squeeth. But then on the short side, it's a little bit more complicated, because I have a collateral ratio that I have to lock up some collateral to make sure I can pay out on my short vol position in case convexity goes against me. Can you touch on the mechanics of actually, going short ETH or Squeeth?
Yeah, sure. So you deposit some ETH, and then you're able to mint some amount of Squeeth, provided that your collateral ratio stays above 1.5. And so we have that collateral ratio is the dollar value of Squeeth, the dollar value of your ETH is your collateral, and the denominator is the value of your debt, which is the value of the Squeeth adjusted by funding. The value of the Squeeth that you've minted, but like with a number which is kind of like constantly decreasing to represent funding. So it's essentially just a normal collateral ratio where you have like your value of your collateral divided by the value of your debt, but the value of the debt is adjusted by what we call a normalization factor, which is a counter which represents how much accumulated funding has happened.
Interesting. And now, a slight difference from being short Squeeth versus being short straddles, and correct me if I'm wrong, I sell a straddle, I can get liquidated if prices go down far enough. Now, can I really get liquidated in my Squeeth position if prices are dropping, spot prices are dropping?
On short Squeeth, sure. Yeah, you can, for short Squeeth, because you'll have some amount of collateral and you'll have some amount of debt. And you're exactly right. On the downside, you can't get liquidated. On the ups, you only get liquidated on the upside.
Interesting. Okay, so I'm essentially sort of selling on the put side. I'm kind of like selling a secured put. It's the upside that is sort of the danger zone for short Squeeth.
Okay. Yes, exactly.
Awesome. Well, obviously, Squeeth is a very interesting product, and I think it's one of those products that's so cutting edge that like it's worth taking the time to like really understand how it works and trade this. And there's probably a lot of opportunity in the Squeeth market. Now, is Opyn focused on other sort of vehicles as well? Maybe like a wrap Bitcoin Squeeth or anything like that on their roadmap, or is Squeeth for ETH sort of the main focus right now?
Yeah, I mean, it's definitely on the roadmap to have so two directions. One in the asset direction to have it across different assets, and then in the level of the power-perpetual. This is a quadratic contract, but you could also have a cubic contract. You can have like a normal perp, so just a power-perpetual with a power of 1. A loan is a power-perpetual with a power of 0. Uniswap is a power-perpetual with a power of 0.5. So there's a family of power-perpetuals, and that's the other direction. So partly across the asset direction and partly across the different powers direction to build a family of power-perpetuals, which allow you to replicate all kinds of different exposures.
That is fascinating. So I've thought about this a lot in traditional finance. So in traditional finance, we have the VIX, then we have VIX futures, then we have VIX future options, which leads to VVIX, which is the VIX of VIX options. Well, theoretically, we could have a VVIX future, and theoretically, we could have VVIX future options, and then have a VVVIX, and so on and so forth. So you're saying that the power-perpetual family is pretty much the same thing. We could go cubic, we could go to the 4th, to the 5th, to whatever number.
Yeah, exactly. Like the 4th, you would start pricing those moments as you go up in higher order power-perpetuals. Then you have to price these higher order moments. It prices these higher order moments evolve. We don't know how much would be practical to price out, but at least cubic and quartic we think would be like that's essentially what like volatile exposures, either explicitly made an index like that, or that you just find naturally occurring in a portfolio of VIX. Can be done as power-perpetuals, or parts of them can be power-perpetuals.
That's awesome. I mean, this is really sort of the cutting edge, not only of DeFi options, but I think of the vol space in a lot of ways that you guys are building here. So Joe, when you're not working on Squeeth or other projects that Opyn, maybe you could kind of share if you have any favorite trading books, and what do you like to do outside of work, sort of, for fun.
Trading was. I really enjoyed Emmanuel Derman's Life as a Quant. Like vol people often they go back to his when he was at the Goldman Sachs trading desk. He wrote everything you want to know about variance swaps, and then there was various riffing on that. And we did a large paper about power perps called "More Than Everything You Want to Know About Power-perpetuals" in homage to Derman and Carney and their work. I used to like Taleb, but I feel he's more of an entertainer now than anything else. He's just he's a shock jock of this of finance, but very entertaining. So I still enjoy. I think it's a great his dynamic hedging book is very simple, but it's a great introduction to practical option trading for people.
I think that's the number one book that we have recommended on the podcast is Dynamic Hedging.
Yeah, I do think there's risks. I mean, it's not very formal, but it's great from getting a real sense of what's going on in a trading book and being very engaging. It's very entertaining.
Cool. And then lastly, what do you do outside of work?
I try to. I just work all the time, mostly, but I go out. I do a bit of CrossFit. I run around. At the moment, I'm reading aloud with my wife. We're reading the Caro Lyndon Johnson biography, 4 1,000-page books on Lyndon Johnson's presidency, which is all really learning about the U.S. political system.
Whoa, that's fascinating. Cool. Well, Joe, thank you so much for coming on the podcast. I think this was super insightful. People are going to appreciate it a lot. And everyone who tuned in, thanks, and we'll see you next time.
Thanks so much for having me. Great to talk.
Absolutely.